start. I am Stephen G. Padilla and I will be the next to discuss numbers 11 to 20. So let's start with number 11. So, number 11. On December, Draco recognized a receivable for taxes paid in prior years or carryback and also had a deferred tax liability from temporary differences. The receivable exceeded the liability. Where should Ash report the tax-related items on its Year 5 balance sheet? So, what do you think? So, let me discuss first. So, in number 11, Just Corporation reports the tax receivable from a carryback as a current asset because it represents a refund that will be collected soon, while the deferred tax liability from temporary differences must be shown as a non-current liability since it since it relates to future taxes. Therefore, the company must present both items separately on the balance sheet, making the correct answer for number 11, letter D. It is both current assets and liabilities. So, let's proceed to number 12. Steven Incorporated deferred tax assets and deferred tax liabilities at year 1 and year 2. So, for year 2, Steven's deferred income tax expense benefit was. So, in number 12, Stevens Incorporated deferred income tax expense or benefit year 2 is computed as the net change in deferred tax assets and deferred tax liabilities because deferred tax expense reflects the effects of temporary differences that increase or decrease future tax amounts. So therefore, for number 12, the correct answer is letter D, the net change in deferred tax assets and liabilities. So, okay, let's proceed to number 12. So, so because the con is different, depreciation methods for tax and financial reporting, it has temporary differences that will reverse next year and increase taxable income. How should deferred income taxes be classified on Gutom's balance sheet? So for number 13, because the timing differences from using different depreciation methods will reverse in future periods and increase taxable income, the resulting deferred income taxes represent future tax obligations and therefore are classified as a non-current liability, making number 13 the answer letter D. It is a non-current liability. So next, let's proceed to number 14. At year end, any deferred tax liability from accelerated depreciation exceeded its deferred tax asset from rent received in advance to reversing next year. How should this be reported? So for number 14, the deferred tax liability is non-current because it relates to accelerated depreciation, which involves long-lived assets. Example of that is like property or equipment. They are an example of long-lived assets. So the deferred tax assets from rent received in advance is current because it reverses next year. So when the liability exceeds the asset, the exceeds is reported as a non-current liability. Again, when the liability exceeds the asset, it is reported as a non-current liability. Since the underlying cost or the depreciation is non-current, the answer for number 14 is letter A. It is reported as an excess as a non-current liability. So, okay, let's proceed to number 15. So, the amount of income tax applicable to items not reported in continuing operations is computed at? So, which of the four choices do you think is the answer to this question? Well, first, let's dive in. So, for number 15, the tax effect for items not part of continuing operations must be separately calculated. Using the effective tax rate is incorrect because that rate applies to the entire continuing income. The correct method is to calculate the tax as the difference between the tax computed with the item included in income and the tax computed without it. So this isolates the specific tax impact of that individual item, leading number 15 to the answer of letter B as the difference in tax computed with and without the item included. Okay, so let's proceed to number 16. So under PFRS, how are deferred tax assets and liabilities classified? Hmm? So let's dive into that first. So for number 16, under PFRS, all deferred tax assets and liabilities are classified as non-current. Let me repeat that again. All deferred tax assets and liabilities are classified as non-current. Why? They are never classified as current, regardless the timing of the underlying temporary difference. This is a key difference from US GAAP, where they are classified based on the related asset or reliability. Understand? So therefore, we conclude that the answer to number 16 is letter B, as it is a non-current only. Okay, so let's proceed to number 17. So number 17, under PFRS, how should HANA Corporation present deferred tax assets and liabilities? So under PFRS, deferred tax assets and liabilities are always presented as non-current. As stated before at the question number 16, both tax assets and liabilities are always presented as non-current. Again, it is presented as non-current. However, they are only netted, meaning single amount is shown if they are related to the same taxing authority. Excuse me. This netting is not permitted if the balances are owed to or from different tax authorities. So therefore, we conclude that number 17, the answer is letter D, deferred tax assets netted against deferred tax liabilities if related to the same taxing authority. So let's proceed to number 18. So obtaining deductible temporary differences at 12/39/24, but is expected to incur losses for 4 years. Okay? 4 years with profit based on group sales. Should entity D recognize a deferred tax asset? So, what do you think should entity D do? Should he recognize it or should he not recognize it? Okay, so let's dive into that question. So, for number 18, a deductible temporary difference normally creates a deferred tax asset. However, when future taxable income is not probable, recognition requires evidence. Hmm? That's normal. So, expected future losses for 4 years mean future profits are not probable. So, the asset can only be recognized if there is a convincing evidence, such as firm sales contracts, to support future probability. So, therefore, for number 18, the answer is letter C. It will only be recognized only if supported by convincing evidence of profitability. So, that's it. Let's proceed to number 19. So, which of the following statements is correct regarding deferred taxes under PFRS? So, which of the four statements is correct regarding deferred tax under PFRS? So, let's dive into that before we conclude which of these four is the correct answer. So, under PFRS, deferred tax assets and liabilities are always classified as non-current. Again and again, I repeat that from question 16 to 17 and to 18. So in 19.2, I will repeat that as to jog your memory and as to, yes. So they are only offset or netted into a single amount if they relate to the same taxing authority or jurisdiction. So this rule prevents netting balances across different tax authorities, ensuring the reported amount reflects the obligation or the asset for a single tax authority. Therefore, for number 19, our answer is letter D. Deferred taxes can be offset only within the same jurisdiction and taxing authority. So, for our last number, we'll proceed to number 20. So for our final number, number 20, a claim is a deferred tax liability from accelerated depreciation on a deferred tax assets from warranty obligations. So which of the following is correct? Okay, okay, are you done reading? So let's proceed and dive into that question. So the deferred tax liability from accelerated depreciation is non-current because it relates to long-term assets. The deferred tax asset from warranties is current if the warranty obligations are expected to settle within 1 year. So under US GAAP, deferred taxes are classified because on the underlying asset or liability since they are not the same classification. They are not netted and are reported separately. Therefore, the answer for our final number, number 20, is letter C. So we only discussed the purchase price and notes, and that is the only correct answer between the four choices regarding the question of number 20. So that is all for our report. May God bless us all. Thank you for listening. That's all. Thank you.